Welcome back to another episode of the Backholder Pod. So I think back to our basics where we talk about all things finance. Specifically in the investment world, I think although we are still technically in a bull market, I think there are renewed concerns around the Federal Reserve rates and how it's going to impact equities by and large. So despite the SPY being up still 13% year to date, it is experiencing some sort of volatility over the last 1 month or so. I think from its near-term peak, it was down around 4 or 5%. For the QQQ, similarly, on a year-to-date basis, still very strong rally, 35% year-to-date, while in the last 1 month or so, from its recent peak, it's also down 5 to 6%. So I'll hand over the time over to Bunti to essentially walk us through around the recent Fed announcement. Despite not raising rates, the market was still a little bit jittery. So Bunti, what's going on?
Yeah, I say need to do some screen sharings to give an impression that we have done some homework here. Okay, actually nothing much. Just showing the implied how to describe this? The probability of future rate hikes. So this one I'm pulling from CME Group. They have this very nice table showing that this is the upcoming FOMC meetings and what are the expected Fed fund rates. So you can see that currently we are at 525 to 550 basis point. If you are seeing that this blue line shifted towards the right hand side, meaning that people are expecting Fed to continue to hiking rates. But so far, so good. You can see that based on the market implied probabilities, right, it should be flat until around mid of next year. Then they will have like a couple of cuts towards the second half of next year. So at least this is the market expectations. But pay attention to this few percentage here. Let's say by December, right, mid-December, 2 meetings from now, there's still like, about 40% probability that we might get another hike. So I think for those who are watching, like Fed's announcement and then try to understand what they are thinking behind the scenes, right? They are they are still watching the inflation and economic data very closely. And so far, the recent economic data shows that the inflations and all this economic is really hotter than what they expected. Meaning that they might need to do more on the monetary side, meaning hiking rates to cool down the inflations. If that's the case, right, probably maybe one more rate hikes. I think that's why after the FOMC meetings, you can see that the stock price also negatively impacted, right? So I think this is the market implied probability. I'll just stop here first.
Okay. I'll pick up where Bunti left off. Okay, so when Bunti mentioned about the year-end two more Fed meetings, actually they have hinted that they might be raising rates one more time. This is their dot plot for 2023. They're planning. Most of them are agreeing that they should be raising to one more time by 25 basis points, which will bring us to 5.5 to 5.75%. But after that, most of them are all of them are agreeing that it will be going down in 2024, but not too much. It's still quite high at 5% average interest rate. Only in 2025, the rates will only go back down to 2.5%. Hopefully, So for those who are taking a home loan, if your home loan is going to be renewed next year, all the best. You're going to be renewing at a very high rate. But for the savers, we will still have one more year of at least 6 more months of high interest rates to enjoy. So you can consider locking in the high rates on your CPF, T-bills, and SSB. Try to lock in all the rates as much as possible.
Hey guys, have you heard?
Heard what? Your stock 10x?
Not yet but Webull fund any amount promo is back.
Wow, any amount?
Any amount. You fund $1 also can. Then you'll get free gifts.
So if you haven't signed up to Webull yet, you can sign up using the links down below.
But
in terms of how the market is trying to react in this and how Jerome Powell actually positioned himself, it's basically, I think what he said is, even though they are leaving it flat, he has been repeating the same script over and over the last few meetings. But I think this time around he came in a little bit harder, where they are hinting that, hey, we might actually see a very high likelihood of an additional increase. And because of this so-called likelihood, the markets are currently back in a limbo. They don't know what's happening. And then once you have uncertainty, people start creating stories on the sidelines. And then that's how you get markets going up and down and being very volatile. So there are some on the sideline saying that, oh, if you want to increase, you might as well increase first so that the market can appreciate the full impact of what the new hike would be, rather than we stay in this limbo and don't really know what or to expect, at least. And it's quite interesting. I saw this term that was thrown out, I think, by Paul himself. He said that 3 consecutive readings does not signify a trend. So I'm not going to go too technical here, but I'm quite interested to see at what reading then they would say that this is confirm a trend. And then after the trend, suddenly it can go down again, then suddenly it doesn't become a trend again, because there are exceptions to the trend. So yeah, that's just my own personal understanding about this whole thing. But maybe I just wanted to throw or open the question to the floor. Maybe Eric had answer. In terms of how we look at this whole hike cycle, right? We know that we are probably nearer to the end of this peaking in terms of the rate hike, and then a lot of people are expecting that rates to go down in 2024. Are you doing anything in particular to kind of hedge your portfolio, or how you're gonna invest your money moving forward? Maybe like what Kelvin said, first put in money in high to explore on the high yield, and then move out and then buy into equities when it starts going down in terms of interest rate. Just wanted to know your own positioning.
For me, I'm basically maximizing my savings, putting in OCBC, UOB, getting about, I would say, close to 4.5 to 5% on the first 100K lah. So I think that's the goal, to hit 100K on these 2 accounts. But beyond that, I think the next highest will be what Kelvin has mentioned in his video, right? The Fullerton Fund 3.7. Yeah. So other than that, I don't really see a lot of other places where we can put our funds. Even T-bills and all that is also around 3.7, right? If I don't recall wrongly, 3.73. So at the moment, I don't really see any good opportunities. Bunti was saying that is what, 18 times, right? S&P.
Yeah.
Yeah, so it's a little bit overvalued. So I personally, I'm not putting more funds into the stock market, because I personally feel that this is a great time for savers. So I just try to milk it for what it's worth. At the same time, also saving up if I want to deploy to a condo, a property.
Right.
Yeah.
So I think Eric's particular situation and circumstances are slightly different. Maybe I think I pivot over to Bunti. Bunti, in terms of your perspective, since he already called you out.
I think everyone have their own, special circumstances. So you just need to do something that's tailored for your own situations. For my own situations is that I started out with quite a huge allocations into equities and started out with 0 cash. So that's why I've been putting a lot more into, like all these money market funds, T-bills over the past, let's call it 3 to 6 months. But one thing I would like to point out, right, is that let me show you this chart. Like we have been talking about, like Fed announcement, which is the FOMC, right? The Fed fund rate, right? But actually what happened last 1 week or so is that even the long-term yield has went up quite a fair bit. So this is US 10-year rate. So you can see that it is currently at 4.4%, meaning that if you just buy a 10-year US Treasury, right, you get 4.4% for the next 10 years. If you hold to maturity, you don't need to care about the subsequent interest rate movement, right? Which I think is quite like a very attractive level. And the last time it was trading at this level, right, is about around 2007, before the global financial crisis. This is like, 16 years ago, right? So I think it really shows that long-term bonds really provide a good alternatives as compared to stock investing. And all this, right, actually between bond market and also the stock market, right, there's also some relationship between them, right? Because let's say imagine that this 4.4%, if you read the news, right, people are saying that the interest rate is not going to, hasn't peaked yet. It will probably still go up a little bit more from the current level. What it means is that it provides a good alternative for other people to park their monies there, right? Then it also means that people will have less money to put into the stock market. So all this, right, if you look at the interest rate, if it continue to go up further, right, I think it's really bad for stock market moving forward. So I've experienced before whereby, you know, stock market experience a huge drawdown and I don't have any cash to deploy, right? So I experienced this in like I think about end of last year. So I don't want to experience it again without cash entering the next drawdown. That's also the reason why I put more into treasury money market funds.
Actually, if you guys follow the CPF SA news, recently the CPF SA has gone up to 4.04%. So basically the calculation is the 10-year Singapore SGS yield plus 1%. Right now, the Singapore bond yield is about 3.4%. If you plus 1%, it's 4.4%. The 12-month average yield is about 4.04%. 12 if you add 1% into it. So if this drags on for a while longer, another 1 year, we will actually see the CPF SA go up to 4.4%. Nothing too exciting, but that's is something good to look forward to lah. So you can enjoy it for another 1-2 quarter before it start to go back down to 4%. But I'm interested to know how Chicken is planning to invest during this period.
Planning to invest, need to first have money, right? So if you no money, nothing to invest also.
I mean, no money. Every month
I think
you have money coming in.
I think in general lah, not just the way in general how I look at investment is I like to look at it when it's on a fire sale, when people don't like a particular sector. And I think I did share in one of my previous backholder pod. I floated the idea that, hey, it does seem like a lot of people now, at least in the Singapore market, those people that has been huge proponents of REITs suddenly all went missing. Suddenly all tell you to go and buy FD, buy whatever lah, all the very safe instruments, money market funds. And when you look at it, look at the entire industry as a whole, a lot of them have traded down quite significantly. And it's not those funny 10% move. It's really like some 20, 30, those weaker ones, 40, 50% drawdown. Of course, there are myriad of concerns behind them. I'm not trying to say that this is an opportunity of a lifetime, but I do see that if whatever that is postulated is going to be true, where we are at the end of the rate hike cycle, you might probably want to be a little bit more skeptical when you look at the bank earnings, because it's they're basically leveraging on the delta, right? The differences in terms of their borrowing rate and their lending rate. So then I'm not too sure whether of course there are huge believers that DBS, OCBC, UOB, they're the kings of SGX market and they cannot fall. I'm not too sure whether they will continue being so profitable, because it's unlike Apple, where they really print cash flow because of the brand equity and the moat. But today, if a business is very subjected to things that are moving around the environment, I don't really know how to assess it. But on the flip side, if you ask me what I'm interested in, I'm slowly reading up, because I'm not really a very well-versed REITs investor. Really need to know a little bit more, but I do see a few things that looks interesting and attractive, and I've been deploying some money here, but in the grander portfolio level, it doesn't move a needle because Alibaba has been a huge letdown, to say the least. But yeah, I mean, in general, in terms of portfolio allocation wise, that's the space that I'm monitoring. And of course, yeah, that's that. Yeah, I'm in similar agreement with Bunti. I do still feel that US market, at least last year, I've been accumulating. This year, a lot lesser. I'm allocating more to Singapore and Hong Kong, actually. Yeah. Yeah. Oh, actually, no lah. I think Taiwan Semiconductor still. Oh, sorry, not financial advice. I should refrain from naming names, but I think the semicon industry in general, we are still in that very low cycle. So I try lah. That's why I say I try to front run the market, but I've been failing thus far. But I like to look at sectors that are beaten down, and these are the few sectors that I do think that they're still beaten down and might take some time. But you need to be very, very patient, because I'm not saying that it's going to recover in the next 3 to 6 months. So yeah. Okay, not financial advice. Any closing thoughts before we end off this video? If not, yeah, hope you guys enjoyed the discussion, and we'll see you in the next video. Goodbye.